Welcome to Simple Investing Secrets, your trusted source for valuable investment insights, stock recommendations, and strategies to help you achieve financial freedom. In today's video, we'll delve into Wall Street's 7 top stock picks for 2024. So before we start, we kindly ask that you like this video and subscribe to our channel for weekly updates. Let's get started. As we step into the new year of 2024, it's a prudent time for investors to take a pause and reassess their investment portfolios, considering the ever-shifting dynamics of the financial landscape. With each passing year, sentiments on Wall Street evolve, and the performance of top stocks from the previous year may continue to influence market trends. Analysts play a crucial role in deciphering market movements, and understanding which companies they are bullish on can provide valuable insights for investors with medium-term investing horizons. Among the perennial favorites that consistently land on analysts' buy lists are the big tech stocks. These industry giants often find themselves in the spotlight, drawing attention from both institutional and retail investors. While they may not promise overnight wealth, these familiar names serve as stable anchors for a well-rounded portfolio. As we delve into 2024, it's worth shining a spotlight on 7 stocks that Wall Street analysts have identified as hot buys for the year, based on positive ratings and market outlooks. It's important to note that while analyst ratings offer valuable insights, they are not infallible predictions of market movements. Let's review our list. Number 1, Amazon. As the dominant force in the e-commerce sector, Amazon continues to be the favored choice of analysts in this domain for 2024. With an impressive tally of 42 buy ratings and a clean slate of 0 hold or sell ratings in the last 3 months, Wall Street exhibits an exceptionally bullish stance toward AMZN stock. Despite concerns about Amazon's seemingly high valuation, there is a willingness to pay a premium for this proven winner, particularly as online shopping becomes deeply ingrained in consumer behavior, especially among the digitally native Gen Z demographic. The forecasted nearly 11% annualized global e-commerce growth through 2027, as per Statista, positions Amazon to capture a substantial share of this expanding market. Projections indicate a significant rise in the company's earnings per share, from $2.69 in 2023 to surpass $11.30 by 2032. This long-term profit trajectory is perceived as justifying Amazon's current market value and even suggesting further potential. Coupled with an anticipated low double-digit sales growth until 2029, the outlook indicates considerable upside for the company. Considering the digital preferences of Gen Z and the overarching momentum in e-commerce, Amazon's commanding position in this space is expected to translate into significant returns over time. The tech giant remains as ambitious as ever, making it a compelling stock to own not just in 2024, but well into the future. Number 2, Meta Platforms. Flashback to mid-2022 when Meta Platforms crashed to $90 per share. Despite the prevalent bearishness at the time, I stayed bullish on this company based on Meta's rock-solid core business. Fast forward 18 months, and Meta stock is now trading at around $346 per share. Optimism reigns supreme on Wall Street, with Meta securing a notable 36 buy recommendations and a mere 1 hold. With expectations that the company's earnings per share will double from 2023 to 2028 as a result of strong double-digit annual revenue growth, the trajectory for Meta looks promising. The initial apprehension surrounding Meta's ambitious metaverse endeavors has proven to be transitory, as the focus on the company's family of apps division, rather than virtual reality, takes center stage as Meta's lucrative cash cow. Contrary to concerns, Meta's financial health is anchored in the sustained popularity and profitability of its family of apps. The consistent engagement on platforms like Facebook and Instagram continues to be a reliable source of revenue for the company. Notably, while Generation Z is often depicted as moving beyond Facebook, the majority of this demographic still maintains active accounts. Furthermore, Instagram remains a social media powerhouse among teenagers, ensuring a steady influx of users. This user retention translates directly to advertiser interest, forming a symbiotic relationship where Meta's coffers grow in tandem with user engagement. The enduring popularity of Facebook and Instagram, which guarantees a steady influx of advertising dollars, highlights the resilience of Meta's revenue streams. The global landscape provides Meta with ample room for untapped growth, presenting the company with significant upside potential. As long as users continue to gravitate toward Meta's platforms, advertisers are poised to follow suit, solidifying Meta's position as a key player in the ever-evolving digital landscape. Number 3. Microsoft. Microsoft continues to stand tall as a favorite among Wall Street analysts, and its resilience during the recent market downturn only adds to its allure. This tech giant not only weathered the overall market slide, but also staged a robust rebound, reaching new highs and reaffirming its position as a stalwart in the industry. While Microsoft's groundbreaking AI initiatives rightly garner significant attention, it's crucial not to overlook the company's expansive footprint across the realms of cloud, software, and hardware. A prime example of this breadth is Azure, Microsoft's cloud computing segment, which witnessed a remarkable 29% revenue increase in the last quarter. This surge has positioned Microsoft to venture into new territories, encroaching on Google's domain through emerging search and browser initiatives. Despite its already impressive standing, MSFT stock boasts an impressive 36 buy rating against a solitary hold, underscoring Wall Street's enduring enthusiasm for Microsoft. Analysts and investors alike share an upbeat outlook thanks to the company's multifaceted strategy that spans several sectors. Microsoft's strategic diversification across different business segments positions it for substantial growth in the foreseeable future. As the tech landscape evolves, Microsoft's ubiquity across various domains becomes a key driver of its success. From AI to cloud computing, the company's involvement in numerous innovative ventures underscores its commitment to staying at the forefront of technological advancements. The impressive financial performance and strategic moves, such as the foray into new markets, contribute to the positive sentiment surrounding Microsoft. The journey ahead appears promising for Microsoft, with its hands deeply entrenched in diverse endeavors. The company's ability to adapt, innovate, and sustain growth across multiple fronts creates an exciting narrative for investors. As Microsoft continues to navigate the dynamic tech landscape, the prospect of substantial growth remains on the horizon. It's indeed a compelling ride for investors, and the diverse array of Microsoft's ventures positions it as a tech titan to watch closely in the coming years. Number 4. Uber Technologies. Uber Technologies stands out as one of the notable success stories in the software sector, surging to unprecedented all-time highs in recent weeks. Uber has established itself as a formidable competitor in the market thanks to strong momentum and a solid balance sheet. The company has received a resounding buy rating from analysts with just one hold, underscoring its remarkable performance. The growth trajectory of Uber is undeniably impressive, with projections indicating a substantial increase in earnings per share from $1.15 in 2024 to an impressive $6.61 in 2032, assuming the current growth trajectory continues. However, a note of caution arises when considering the valuation, as Uber's forward price-to-earnings ratio exceeds 53 times based on 2024 earnings. Despite the enticing prospects of turbocharged profit growth, the rich valuation prompts a prudent approach. In alignment with the loan hold rating, the consideration of a forward multiple surpassing 53 times by 2024 suggests a cautious stance. While the anticipated robust profit growth is appealing, the current valuation prompts a thoughtful pause. The expected decline in Uber's forward multiple to around 9 times by 2032, based on income projections, underscores the need for investors to weigh the upfront payment against the associated risks. Diverging from entrenched tech giants, Uber operates within the more focused rideshare niche and is still in the process of working towards mainstream adoption. Opting for a wait-and-see strategy for a more opportune entry point emerges as a prudent approach before committing to stock trading at over 9 times potential 2032 earnings. For long-term bullish investors, the option to overlook this caution and adopt a buy-and-hold strategy may be considered, but a patient approach could prove beneficial for those seeking to navigate the evolving landscape of Uber's market dynamics. Number 5. CrowdStrike. Looking back to March 2023, when the first endorsement for CrowdStrike was made, the company's staggering growth metrics were undeniably enticing. However, with the current valuation extending beyond 85 times forward earnings and 20 times forward sales, there is hesitation, even as CrowdStrike maintains 34 buy recommendations and faces only 2 hold ratings from Wall Street analysts. Undoubtedly, the cybersecurity industry's favorable winds are expected to drive CrowdStrike to new heights throughout the upcoming decade. Nevertheless, justifying today's exceptionally steep premium becomes challenging, especially when even the most optimistic revenue projections for 2033 still position CRWD stock at nearly 3 times next year's sales. Purchasing at these current elevated levels may require a particularly bullish perspective, and only the most eager bulls might attempt to rationalize such a decision. Number 6. Nvidia. Like CrowdStrike, Nvidia appears to bake highly optimistic growth assumptions into its currently lofty valuation. Sure, Nvidia has knocked recent quarterly earnings reports out of the park, but looking ahead, risks definitely loom large, both from AI chip-making rivals rapidly narrowing the technology gap and uncertainty permeating the still emerging and largely unprofitable AI landscape overall. We believe Wall Street largely overestimates Nvidia's future prospects while seriously discounting the competitive and industry headwinds that could plausibly dampen growth. Nvidia earns an overwhelmingly positive 31 buy ratings against 3 mere hold ratings. Analysts clearly envisage blue skies dominating ahead. We respectfully disagree with that upbeat prognosis and suggest prospective investors wait for a better entry point before jumping aboard. Number 7. Palo Alto Networks. Palo Alto Networks falls into the same frothy camp. This company has posted stellar market-beating performance in previous quarters and holds a leadership position in the cybersecurity space. However, PNW stock appears to be priced to sheer perfection. Especially compared to high-flying cybersecurity peer CrowdStrike, Palo Alto's top-line growth metrics look rather pedestrian moving forward. Yet, PNW stock still trades at remarkably rich earnings multiples, even when looking at 2033 projections. With 30 buy ratings against just 4 hold ratings, Wall Street analysts overwhelmingly endorse Palo Alto Networks. However, we believe waiting for an inevitable pullback should deliver a much better risk-reward upside for investors not currently holding this stock. We would personally replace these cybersecurity picks with Apple and Berkshire Hathaway if it weren't for our basing these picks purely on Wall Street ratings. As a reminder, always conduct thorough due diligence before investing your hard-earned cash in stocks or the market. Don't forget to show your support by liking this video and subscribing to our channel for weekly updates on the best stocks to buy and cutting-edge investment strategies for building wealth. Thank you for watching, and may your investments thrive in the years ahead.